Hi, I'm Stephen from TEFAT, and tonight I'd like to give a presentation on the profit and loss statement. The profit and loss statement can be used for internal information for the company, or it's also called the revenue statement or the income statement. It can be used for budgeting, but if it's used at the end of the financial year for official reporting in the accounting standards, it's called financial statement for financial performance, and the balance sheet is called statement of position. Yeah. So it's the statement for financial performance for the year, but I'm just going to consider this like a for internal use for the company, a P&L, and always put a title, otherwise you'll lose a mark. So just label it and what the company is, contrast, and which year it is. So you start with sales or income, which is a credit item, and then in this case 160,000 for the year, and then directly below sales is less COGS. Now, cost of goods sold, or the cost of sales, is expenses that are directly proportionate to immediate manufacturing or wholesaling, and other costs in the profit and loss account are below this in categories of marketing, operating expenses, and financial expenses. So COGS is directly linked to production. So COGS is defined as opening stock. You're dealing with inventory. For example, shoes on a shoe shelf in a shoe shop. Opening inventory of the shoes, 60,000, plus purchases of the shoes, 80,000, gives you opening stock plus purchases, gives you goods available for sale, GAFs. The total inventory on the store shelf. Now, at the end of the period, whether it's a quarter or a month, you audit the closing inventory, a stock take in the old periodics measurement of inventory, where you've got to do a stock take and count the stock on the shelf, but more often than not the computer counts it, the closing stock, so it's labelled perpetual inventory. But often companies do a combination of both periodic counting of inventory and perpetual, because you have issues such as theft, unfortunately. So we're up to opening stock plus purchases, goods available for sale, minus closing inventory after the stock take, and that gives you a final figure of COGS once you compute those numbers. Now, the difference between sales and COGS is gross profit. Gross profit, and those items are all in the trading account. And if there's any discount received on inventory, it's calculated here as well. So below gross profit is from the trading account to the profit and loss account. So all these items of expenses, overheads, and so on are categorized in the profit and loss account. So the first category, often in a statement of financial performance, you'll see just all the expenses listed below gross profit to get total operating expenses, but I've divided it into operating expenses, marketing expenses, and financial expenses for clarity. So one operating expense is rent, 80,000 per annum, And continuing over here, salary and wages is in operating expenses, so is sales commission, sales bonuses, stationery, electricity, freight out, freight going out from your company, insurance, depreciation expense is here too. Amortization. What is amortization? It's similar to depreciation, where you calculate a depreciation expense each year for assets, and then the depreciation expense is just for 1 year, and the total of depreciation expense for all the years is in accumulated depreciation, which isn't shown on the P&L. And that's depreciation expense is just 1 year. So amortization is reducing the value each year of intangible assets, and goodwill is a good example how goodwill is amortized. The value eventually runs down over the time. What is goodwill? Goodwill is when a business purchases a business over with a purchase price over and above the intricate net asset value, and it incorporates things such as the company having a good name, good turnover, good customer base, and good the purchasers of a company are willing to pay more than the net asset value. So goodwill has to be amortized. In this case it was zero. Bad debts, when your some people in your accounts receivable account don't pay the debt. First it's a doubtful debt, and then it's a bad debt. In this case zero. Payroll tax. In Australia at the state level, the state governments have implemented payroll tax for many years. So you add up all these expenses from rent right down to payroll tax, and you get total operating expenses $164,230. So you add up all the operating expenses to get a total for operating expenses, okay? And just over the whiteboard, the next category will be marketing and sales. Now I've put the salaries all in operating expenses, but your marketing and sales expenses, items such as advertising campaigns in the TV and radio, and leaflets and catalogues, e-commerce expenses. So you get a figure for total marketing and sales expenses. So you add up 750 plus 300 plus 200 gives you that figure, 1250. And then the next category is less financial expenses. Financial expenses are expenses associated with debt financing, such as loans and credit cards. All the financial expenses. Examples: interest expense, fee to restructure a loan, bank charges, fees on company credit cards, and so you get total financial expenses for the year by adding up those figures in financial expenses. So now at this point we've got three subtotals. A subtotal for operating expenses, also called administration expenses. We've got a subtotal for marketing and sales department, and we've got a total for financial expenses. Now what we do is we add up all the total expenses in the profit and loss account below gross profit, and we get that figure there, 166 100. And if you remember over the whiteboard, our gross profit was 100,000, so this gives us a loss. It's not a profit. Net profit or loss before tax, and we've calculated a loss of 66,100. Those brackets indicates a minus figure. Okay, every time you see brackets around the figure, that's a minus figure. So the Australian Taxation Office won't charge tax on a company that's sustained a loss in the year. That can be carried forward 5 years, and then it can't be carried beyond 5 years. So in this case, the net, because the tax expense is zero, remitted to the ATO, the net profit before tax is the same as net loss after tax, and that's a negative figure, a loss. So if it's a statement of financial performance, you'll see items below this, abnormal items, which can be positive or negative, and abnormal items are defined as infrequent items which occur from time to time. And then you've also got extraordinary items which are unlikely to occur again, such as a COVID pandemic. So examples of abnormal items: gain on sale of equipment, sale of intellectual property such as royalties, logos, brands, trademarks and patents. Extraordinary items unlikely to occur, such as Qantas being subject to the COVID pandemic and the cessation of flights in the COVID lockdown. Now, in a loss situation for a company, they're faced with a situation of being short of cash, so they have to either finance internally from retained earnings in the balance sheet, use their own retained earnings in the balance sheet, owner's equity, to finance operations for the year, or they can withhold dividends to shareholders if they're a private company or a public listed company, or they can get a loan from a financial institution such as a bank or a credit union. And there's also some general journal entries for both the profit and loss account and trading account, and these have to be done just before the financial statements are drawn up. And in the trading account, to close off all the accounts for the year, you debit sales and credit the trading account. You debit trading and credit the COGS items such as inventory purchases, freight in. You debit closing inventory and credit the trading account, closing off the inventory for the year. And finally, after these three general journal entries have been completed, you transfer gross profit to the profit and loss account. So you debit the trading account and credit profit and loss. Over to profit and loss, just before the financial statement of the P&L is put out, you debit discount received and gain on sale of equipment and credit P&L. You debit profit and loss and all the expenses that we saw before below gross profit line, such as advertising, wages, stationery, stamps, etc., electricity. Also, you debit profit and loss and credit capital when you transfer profit to owner's equity. So that profit for the year becomes old profits and it's transferred to the balance sheet in owner's equity. And that's the general journal entry to do that. Finally, drawings to the owner for personal expenses from owner's equity has to be cleared to zero, so you debit capital and credit drawings. So these are the general journal entries that have to be completed before the financial statements. I'll show you a page 225 from a textbook I used at TAFE, Applications of Accounting Procedures. The authors Paul McGrath and Rex Walsh, and There's, just make sure it's in focus. They're those, I'll have to hold it closer. They're those general journal entries for the trading account. For example, debit sales, credit trading. Debit trading, credit those COGS items. Debit inventory, credit trading when the closing stock is transferred to the profit and loss account, and abnormal type items and discount receive transferred to the profit and loss as well. Also expenses below gross profit, debit profit and loss, and credit those expenses. Expenses normally a debit item, but in this case a credit item, and when profit and loss transferred to capital, and closing off drawings we mentioned. So that's McGrath and Walsh, page 225, a book I used. Now, I just want to kind of sum up or recap by going over some notes on my PC, and been losing this document for some reason. Yeah, there it is. So before the profit and loss statement is drawn up, the company has to make general journal entries, and which we just mentioned, in both the trading and the profit and loss account. For example, debit profit and loss account and credit expenses. The trading account is all the items where sales is minus COGS gives you gross profit. That's the trading account. And items below that we mentioned are the profit and loss account. Remember that in the income statement, income is matched to expenses. So income is a credit item, and expenses are a debit item in the P&L. And so that's just those entries where we mention where drawings has to go down to zero by the general journal entry, which is debit, capital and credit drawings. Don't forget to put a title or you'll lose a mark, and label these items clearly, and always make don't forget your subtotals of things such as COGS and total operating expenses, total marketing expenses, total financial expenses. Add up all those expenses in the profit and loss account below the gross profit line to get total profit and loss account expenses, and then you take gross profit minus those total expenses, which gives you net profit before tax. And then usually you've got a profit and you pay tax, and then you get the bottom line, which is net profit after tax. But in our case we had a loss, and this has been happening in the COVID economy, where businesses are subject to lockdowns and cease trading. So be clear about the categorization of whether an expense is admin or financial or marketing sales is fairly easy to recognize. And yeah, so gross profit less the total profit and loss account expenses gives you net profit before tax, then your tax, and then net profit after tax. Revenue as earnings. So get used to the definitions. We've clarified the difference between the trading account and the P&L account. What is it? And yeah, in the trading account, it's all your COGS items and your sales at the top of the P&L. And I think we're just about getting there. Yeah, so what is COGS? It's opening stock of the inventory plus purchases, gives you goods available for sale, and then a stock take minus closing inventory gives you a COGS figure. So sales minus COGS gives you gross profit. And as I mentioned, know the definitions of the different expenses. If you're asked to do general journal entries, transposing them, posting them to general ledger. And then finally, these figures are posted to the financial statements. Know the difference between abnormal and extraordinary items. Abnormal items occur from time to time, but extraordinary items are extremely rare. Both these categories have plus or minus figures, gains and losses, and these items are listed below the net profit after tax. Okay, and look up an example of a corporation statement of financial performance such as NRMA, Qantas, Telstra, and look at the pro forma, the template that the statement of financial performance is written up. So you may be asked to do those general ledger, trading account and profit and loss journal entries. Perhaps they're just giving asking you to calculate a revenue statement. So that's my source for that page, McGrath and Walsh Applications of Accounting Procedures Workbook. Yeah, the publisher, the place and the year and the page number. So I hope you found this useful. I'm Stephen from TEFAT in Sydney, and have a good day, and see you next time. My next presentation will be on the cash flow statement. Thank you. Bye.